What's up, millionaires? It's Alexander Victor here with your moment of financial zen. Alright, so what we're about to listen is the recording of the call that I did on 25th of January for those of you guys who missed it. It's not my first call, but this is the first time I recorded it. So listen in, take notes, let me know what you think at the end of the video. Don't forget to like and subscribe. Let's get into it. TSP allows us to, have a retirement return after the age of 65, intentionally to 65 to death, right? And depending on the fund that you're going to, like the biggest BS I've ever seen was, and I didn't really know at the time. I don't think anybody knows much. You're in boot camp, they tell you, hey, get the TSP and then get into the G fund, it's a savings account. And I remember when I was going through boot camp, it was like 2008. It was like in the middle of the fucking crisis, and I remember RDC's talking about losing half whatever they had, and the safest thing was to just get in a G fund and then you could always move it later, right? So I was like, okay, I don't know what I'm doing. I'm just gonna get a G fund, all right? And the G funds, 2.5% return on whatever you put in there, whatever, right? So I was calculating it out when I was learning about finance. I was calculating it out to see, if I were to, because I think the recommendation to put in your G fund was like what everybody was saying was like 10%, right? And calculating it out at 10%, you might get a million. I think 1.2 million if you do that 10% for 20 years, and of course you make rank and everything, 1.2 million, which is great, but that nobody ever really talked about, if you wanted to switch a fund and switch it to L fund, whatever, but nobody really talked about the other funds. So when I started looking into it and I switched over to I looked at the return for the C fund, the return for the S fund, and those returns were about 13%. And I didn't really learn until I take the finance how big of an impact a return would be, right? And the average for a 10-year return, it's not like 1 year, 13%. That's a 10-year average, right? So if you keep with that average for the next 3 decades, right? So when you actually use the money, and instead of that 2.5%, you use that 13%. The difference between where you're at in the G fund at giving 10% of your paycheck, putting in a G fund, letting it sit there, and maybe getting 1.2 grand at 1.2 million at 65 and a half. Instead, you take it, you put it in the you put it in the C and S fund, C fund or the S fund, at 13.5% return for the same amount of time period. And if you continue the contributions, it's gonna be like something like $20 million, bro. It was insane. I was like, okay, so what am I gonna do with $20 million at 65? And I can't use it till I'm 65. You know what I'm saying? I can't use it till I'm 65. That's insane. I couldn't believe it. So I was like, okay, so here, the move was obvious. Move it to the CNS fund. But then I took it one step further because I was like, like I said, what am I going to do with $20 million out of nowhere at 65? Let me, if I stop contributing to it and just let it sit there, then still, and it just compounds on itself, and if I stop it right now, that, it should end up at like about 5.5 or $6 million by the same age if I just stopped contributing now. You know what I'm saying? So again, what am I going to do with $6 million at 65 that I couldn't do in the first two quarters of my life? You know what I'm saying? And so I stopped contributing because I'm actually going to need that money more, not from 65 to death, because just living off of 1 million. And think about it, right? The return for an average person that's invested in the stock market, 7% per year, right? And we're getting 2.5% out of the G fund. We're just getting screwed at the G fund, So the average return was 7% per year. Then you have to think about the 4% rule, which is what people don't really tell you is what you do with the money after you retire. People would automatically think, okay, I get $1.2 million, and I'm just going to spend a piece of that $1.2 million every year until the year that I die. And if you do that, then it might last you, if you live like 40 grand a year, you know what I'm saying, like that. I can just math it out real quick. But the thing what people think that they have to do with their $1 million is live off a portion of that every year for the rest of their life, and that's not actually how it's supposed to be done. If you take $1 million and you divide it by 30 years, you get $33,000 a year, which is the poverty limit. So after working all your life to and then take cash out the money, and then $1 million for 30 years, and say you live to 100. I mean, some people live longer. You live at the poverty limit, at the poverty line until you turn 100, and then you're broke. Come on, you know what I'm saying? That's not right. So what it actually is, what you're supposed to do is what's called the 4% rule, and take however money you have invested, and if the average person returns 7% per year, right, off $1 million, then that comes out to $70,000 per year if you're returning 7% per year, which is pretty good. You can live off of 70 grand a year. I mean, that's more than I get paid now, so you can live off 70 grand a year, right? But actually, if you were the 4% rule is take 4% and use that 4%, which would be 40 grand, which is 40 grand. It's not even taking off your principal. It's a little bit more than you would do if you did the first step, and then you add in your Social Security in there. Your Social Security is about maybe like 1 to 2 grand, you know what I'm saying, and you can live off of that. At 65, you ain't going really anywhere anyway, doing anything lavish, So, but that's off 7%, right? Now, what's not taken into consideration is that that's the average person making 70% of 7%. And the reason why average person makes 7% is because the money is managed by these financial institutions, which we were talking about before. These financial institutions are robbing us of generational wealth, essentially, because it's their job to, aka or in air quotations, protect our money by giving us a less risky investment on return on the money that we worked our entire lives for. But they're not telling the absolute truth. They're just kind of protecting their jobs, taking the money and throwing it into dividend stocks, and the stocks really don't raise much in equity, but it returns in dividends. So it gives you maybe a couple grand a year, which is good, and that's acceptable for a lot of people that don't know about finance, because they don't know how much you actually can make, and just by ticking up the risk factor, and really you call it risk, but the risk comes back. It's not like you putting your money over a fire pit. These are reputable companies, the Apples, the Googles, the Amazons, the Facebooks, that are going to be around for a while. That just until I guess now, where the millennials, for the past decade we barely had any money. The millennials came in the heart of the fucking recession, and really couldn't get any money until now. All the millennials turned 30-somethings and just finally have money and could take advantage of this COVID crash, and now it births Wall Street bets. That's essentially what's happened. You know what I'm saying? So now when you talk about 7% per year, I'm looking at that number. I really started seriously investing in at the end of the COVID crash, which a lot of that's Robinhood just came online really for free trades and stuff, and I've been investing for years before that, but I really didn't put serious money into the COVID crash, because it used to cost $6.75 per trade, and that was the cheapest one. That was Capital One Investment. That was back in 2014, and that was the cheapest one. And Robinhood came online talking about some free trades. What? So I moved over to Robinhood, and I was like, okay, free trades, got it. I have cash on the side, got it. Jumped into the market seriously, and we were talking about the average person makes 7% per year. Man, haven't been a year yet. My return is 210%, and I'm not day trading. I'm just buying good companies, and and so here's where retirement hacking comes in. if the average person can live off of 4% per se, right? And off of companies that are out there that just aren't being, taken seriously. In order for a company to be taken seriously by a financial institution, it's got to be around for like 10 years, But there's companies out there that are good companies that just don't meet the check blocks of the old, slow elephant, navigating a go-kart track financial institutions. They're not taking these companies seriously, and but we as retail investors, we can see the future because we are the future. So just take the money, put it into these investments. Instead of making 7%, I can make 7% in a day. And where I end up, it's not even been a year yet. I'm making 212%. Not even been a year. What can I do next year? What can I do the year after? Because if I continue this trend, I'll be a millionaire in less than 5 years. It's insane on the return that you could get. So here's how the retirement hacking works. All right, capital gains tax capital gains. The whole tax code was rewritten by Trump a couple years ago, and a lot of people boohoo whatever. You can take advantage of the shit if you just read. You can take advantage of shit, right? So the capital gains tax, what it says is that if you make less than 40K a year, and you're single, and you have a long-term investment, which is long-term investment in the stock market, it's 366 days. You make a long-term investment, you get taxed zero for 40K if you're single, 80K if you're married, and you and your wife make less than 80K taxable. There's capital gains tax on that, zero. That means if you hold a stock for 1 year and 1 day, and you decide to sell that stock, and you and your wife together make less than 80K, and the proceeds of that sale, of course, ends up less than 80K, then the government taxes you $0, right? Which is incredible because base pay, you don't make that much. You know what I'm saying? So, so you could take advantage of this by simply buying stocks regularly, holding them for more than a year, keeping your taxable income less than 80K, and selling it only when you need it, right? So another thing that I learned in accounting is that so how does this method work? Because what people don't realize is that you can actually there's two different methods in when you're talking about moving market, right? So there's what's called first in first out, which is FIFO, and last in first out, which is LIFO. When you're talking about merchandise, moving merchandise for a company, right? And that's how you as a company that's how you end up valuing your merchandise. How much your company is worth is based off of the merchandise that you have, right? To give a short example, you sell houseplants, right? And you bought a houseplant from a wholesaler. You bought 20 ficuses, right, for $10 each, right? And then the next month you buy 30 ficuses for $5 each from a different seller, right? So how much is your merchandise worth? You see what I'm saying? Because when you the amount that you bought the ficuses first for changes from the first month to the second month because you found a different supplier, right? So how much your merchandise is worth depends on which method you're using. FIFO, first in first out, means that if you sell 10 ficuses in the third month, right? Are you selling first 10 ficuses that you bought in the first month, which would mean that you're selling them, you're getting rid of essentially $10 times 10 for each of the ficuses that you bought in the first month, or are you selling the ficuses that you bought in the second month for $5 a piece? You know what I'm saying? Because that's going to change the value of your merchandise. Does that make sense? It's a very complicated process, so just try to stick with me, all right? But all right, so let's say, because they're all ficuses in the end, so how much is your merchandise worth? So these two methods these company uses, right, is part of the generally accepted accounting procedures, right? So, how much is your merchandise worth? Now, instead of ficuses, we're talking stocks, right? So when we're talking stocks, let's say you buy, you know, five Apple shares this month, and then next month you buy 10 Apple stocks, right? And the next month the 10 Apple stocks are worth more than the 5 Apple stocks that you buy this month. And then the third month you sell 2 Apple stocks. Which Apple stocks did you sell? Did you sell the stocks that you bought in the first month, or did you buy the Apple stocks that you bought in the second month? Because the capital gains tax is going to take into consideration how long you had those stocks for, so that they determine how much to tax you. Does that make sense? So the method that F.I.R.E uses is called first in, first out. That means the first stocks that you bought are the first stocks that you sell. And those are going to be the ones that you taxed on. Okay? That means, since F.I.R.E is using this method, first in, first out, if you buy a stock January 1st, 2021 of Apple, and the next year, and you continue to buy it February, March, April, whatever, right? And you decide you wanted to sell, you need to get some money out, and you wanted to sell your Apple stock, right? Instead of, when it comes to January 1st, 2022, instead of end up selling the last shares that you just bought, you're going to end up selling the first shares that you just bought. And the difference between the money that you put in there and where the stock price is now is what you're going to get taxed on. So let's say you bought it January 1st, 2021, and you held it for a year, and now you bought it at $50 and it went up $60. What you're going to end up paying tax on if you sold that one share in 1 year is the difference between 50 and 60, which is $10. So that $10 you're going to end up paying tax on. Now, based on the tax bracket that you're in, the $40, the $80, the 40 grand, the 80 grand between you and your wife, right? That is the money that you're going to get taxed on. Now, if you're making less than 80 grand and you sell the one share of Apple and you hold it for 1 year, you're paying $0, right? So theoretically, if you bought, let's say you keep your expenses less than 80 grand a year. If you bought one share of Apple this year and sold it next year, you would pay 0 in taxes because it's first in, first out, and you held it for a year, right? So let's continue that. Let's buy in January Apple January 1st, 2021, and let's hold that shit for a year, right? And then we'll buy another one January 1st, 2022, January 1st, 2023, January 1st, 2024, right? So, and you do that for 5 years straight, right? And you're getting gains or whatever, right? So you decide you wanted to retire in 5 years, right? And like I said, how I mentioned before, where the average person is making 7%, all you gotta do is find some good stocks. It's not hard to find a stock that returns 20% in a year. Actually, all the ones that I've valued so far, I can't tell you, one of them that returns less than 20% in a year. So 20% is not hard to come by, you know what I'm saying? Especially if you're diversified. 20% in a year is pretty easy.
Okay, so in the example in which you have $200,000 after saving for 5 years and getting a 40% return, if you do that for 5 years, you should have $278,000. But just for the sake of example, let's say everything doesn't go right. You have $200,000 within the savings, which is pretty easy. Okay. Year 6, with a 40% return on that $200,000, is going to get you $280,000. You can withdraw 20%, which is half of what you return in a year. That 20% is going to equal $56,000 because you invested it over 5 years ago, because it's going to be, first in, first out. You get taxed $0. You keep the other 20% invested. Year 7, the other 20% that's invested is going to give you $224,000 over the next year, average return of 40. At the end of the year, you should have $313,600. You can withdraw 20% like you did the year before, and actually it'd be more. But let's just say you really don't need that much, and you can live off of about the same, which is $56,448, which is 18%. Again, because you invested it in that first year, and let's say you haven't yet even eaten up the returns from the first year's investment yet, the principal of the first year's investment, with the returns on top. You're still within year zero. Okay. You can withdraw 18%, get that $56,448. Withdraw that 18%, spend it throughout the year, and leave the other half of that 40%, continue to invest it. So, beginning of the year, you start with $257,152, return of 40%. At the end of the year, $360,012, and you can withdraw even lesser percentage and get still even more money back. This cycle continues. Only thing that needs to remain is a return percentage of really above what you withdraw. You don't withdraw anymore. And again, because it keeps gaining returns, you're barely even going to eat up the returns on year zero. You may seep into year one. But even if you have more money over the years, you can still buy in a little bit in year 7, year 8. Let's say you have leftovers or whatever. Okay? Or you find money from somewhere else. You can still buy in and just keep the trend going. Okay? This is retirement hacking. This is a infinite money hack. The trend is going to continue. The more you invest in the earlier years, don't take it out until year 6. Start withdrawing less than the returns, and you will never run out of money.
Up front. But anyways, so I just wanted to point that out, that this retirement hacking this thing is possible, and I believe in this theory so much. Within the next 5 years, because it hasn't been a year yet, but I've already started doing it because I don't see how it could fail. Right? So, that's retirement hacking. And I think this is eventually catch on, which people realize that they don't even need millions to retire. You can do it with a few $100,000, and you just find some good stocks to return off of. In order to do it, you need Robinhood, which is easy to get, it's free download. You need what's that called? Fractional shares, which comes automatically when you download Robinhood now. So everybody has the makeup to do it. All that's got to happen is Robinhood got to stick around. And as long as Robinhood is going to stick around killing the game right now, there's going to be other companies that do the same exact thing, And again, it's retirement hacking. You do it, zero taxes, you continue to live off of it, it returns higher, the companies are there, you just got to buy into them. It's not day trading, so it's not like you got to do much work. It's incredible. This whole theory is incredible, and I call it a theory because I haven't proven it yet, because it hasn't even been a whole year yet. You know what I'm saying? But I'm gonna keep talking about it, and then once I start doing it, then people are gonna start catching on. All right, so CRISPR Therapeutics, man. This is an incredible company, which is gonna take off in the next maybe decade, maybe 2 decades, but. Right now, CRISPR, what they do is they had to do genetic engineering. Now, back in 2000, we figured out how to, decipher the human genome, right? And code it. And for the next decade, essentially, we've been trying to map it and code it and learn it. Right, and I think they finally figured out how to do it like 2012. They coded the first human genome, and they can map it and code it and everything like that. And And now that we understand it, read it, we can change it. And so where that's revolutionary is that, if you could change DNA, you can, add things that didn't have in there before and delete things that you don't want, like genetic diseases, right? Now it sounds preposterous that you could be able to just delete diseases into the next generation of humans, and that's going to be controversial, with religion and stuff like that. And I think that's going to take a while to take off. But you know what's not controversial and what's closer? Everyone, especially when we're talking about um, uh, people are having less kids these days in first world countries, right? People having less kids these days. People aren't able to go out and socialize, and people are getting more and more pets, dude. People are getting more and more pets, and the, people love their pets. You especially okay. Imagine you went to a pet store, right? You want to get a dog, right? And there's two dog options. There's dog option one, which is buy this dog in the store, right? It's been inbred for many, many generations, and because of that, is expected to live 15 years, and its last year or so, it's going to suffer cancer, it's going to suffer blindness, stuff like that, because those are genetic diseases with that chain, right? But for the first 14 years, you're gonna love the hell out of that dog, because the dog is fluffy, whatever. Maybe the dog might be bark a little bit, whatever. You know what I'm saying? But you're gonna love that dog for the first 14 years, right? You can buy this dog for a couple grand. You can't do anything with it, right? Option two, you could custom order your dog, right? You could custom order a dog, big, small, friendly, angry, hypoallergenic. When it's born, it's neutered or it's spayed. It already can't reproduce. It doesn't bark much. It's eye color is green and blue. It can do this. It can do whatever. It's extremely smart. It's whatever you want it to be. Check the block. Order the dog. They can genetically engineer that dog to do whatever you checked. And not only that, because it doesn't have genetic diseases, that dog's gonna live 20% longer. And because you didn't have to go through, the selection of, breeding and whatever, it's actually going to be cheaper. Because the pet stores are going to have the genetic strains in order to order that dog, and have the embryos pre-made. You know what I'm saying? To fit your custom, to fit your custom, and it's not as inhumane as we're doing it now. You see what I'm saying? What it's going to do to pets is fucking revolutionize, uh, how people are customizing their pets and getting pets in their home, you know. Um, and so the CRISPR company, though they might be not be talking about animals right now, I could definitely see that happening before we start genetically engineering humans, because we got a whole medical field to worry about. But I could see it happening in pets first, you know. Uh, you see what I mean? So CRISPR, since I bought CRISPR, I think it's quadrupled in price. And look at it, I had it less than a year. It's just getting started, because what CRISPR is doing is creating essentially is creating the books, and it's going to sell those books as patents to other companies, which is going to carry out the reproduction of whatever is being genetically engineered. It doesn't stop with animals. It doesn't stop with humans. You're talking about plants as well. You know, you talking about You asked me about Planet 13 earlier. Imagine you can specifically genetically engineer a strain of marijuana to whatever you want. To specifically target whatever it is that you want. It's crazy what you could do. So that's where we're at right now. And again, we're right around the corner of this taking off. It's still under people's radar. Once it catches on, it's going to be too late. Once people find out about it. But there's at least 10 companies right now that are going to be using CRISPR technologies and selling it to the market, right? CRISPR is business to business. But there's going to be 10 other companies that are business to consumer that get the genetic strains, create whatever it is, and sell it to the consumer. So you want to get on CRISPR, bro. I've been buying CRISPR. Yeah, I've been buying CRISPR options. That and it's insane what that's going to be in the next 10, 20 years. Long term hold, and that thing's going to take off, and yeah, it's taking off, and you got to get on it, man. You got to get on it. All right, the last one I'm going to talk about is so there's this new, actually, there's one more I want to talk about. So there's this ETF. An ETF is instead of like diversifying, really, and finding a bunch of different companies in order to balance my own portfolio, I just put the stuff in an ETF. There's people out there that they do research that I don't have access to, and they make returns. I'm specifically talking about ARK Invest. Um, ARK Invest is on it. They've been on it for 5 years. People don't really know about it because it's only been around for 5 years. And like I said, when it comes to finance, people don't take stuff seriously until it's been around for 10 years. You know, so ARK Invest has gained over 100% return in the past year, and it has been doing it for the past 5 years, and it's going to continue on. Once people find out about it, it's incredible, especially the millennial and Gen Z generation. So if I don't know, if I have money, I don't know what to buy, I'm buying ARK Invest. Okay, so ARK Invest has 5 ETFs right now. One's for genomic engineering, one's for next generation internet, one's for the EV market, one's for robotics. So you see where they're going, right? Companies for the future, growth companies, right? And what I didn't know is, where a lot of these companies are just growth companies. ARK Invest is actually, so they're ETF that invest in growth companies, but they're actually they offer dividends. I didn't even know that because at the end of the year I was getting, at the end of the year they pay out the dividends. I was getting like, okay, $140 dividend here from ARK Invest, 160 dividend here, and I was like, whoa, I wasn't expecting this. I already had 100% return from ARK Invest. So yeah. So when it comes to dividends, I don't need my dividends every month. If they're going to give out dividends, hey, I'm good. And actually, I don't need it at all, so I just reinvest it. But somebody who, and you think about it, right? If you give a dividend stocks really don't raise much over the year. They don't move at all, right? So, and because they're taking out money every month to give it back to the guys, it's like a paycheck, but it's a really small paycheck for how much money you got to put into them to get that money, right? So instead of doing that, I'd rather them just hold on to the money for the entire year, and at the end of the year, give me way more. Plus, it's raising. I mean, it's such a genius plan, So, like, if I already did the math. Like, if I were to take the same amount of money and put it into like realty REIT, and and even though they pay me monthly, they still would not have paid me out as much as as much as ARK Invest paid me in one-time payment. And as long as I, hold on to that money, and spread it out over, instead of them paying me monthly, I just hold on to it and pay it out to myself whenever I need it. Does that make sense? But I don't need to do that right now, so it's just reinvested. It goes right back into ARK. So when I need it, shoot, I might just throw, like, at the end. Of course, we always have to have an end game, right? So when I at the end, if I could either do my retirement hacking plan, or just throw everything in the ARK and get at the beginning of every year get a dividend payment from them, and just live off of that. You know what I'm saying? But I don't really want to do that because on dividends you get taxed on it. So I'd rather go with the tax-free plan. So anyways, moving on. So ARK Invest is coming out with another ETF, and I'm literally waiting for. I'm not going to buy any more stocks until they come out with this ETF. And you already see what the different fields that they're investing in, all the hot fields. When I'm talking about EVs and next generation internet and genetic engineering. The next field that you're probably expecting to hear is space exploration, which they're coming out with that dividend. That they're coming out with that ETF in, I believe, March. oh man, that shit's gonna blow off. That shit's gonna blow up, you know. So, and we know when they come out with the IPO of that ETF, it's gonna be $10, $15 maybe, and yeah, I'm just gonna just throw money at it, just throw money at it, you know. Shut up and take my money because, you know, they already have a good relationship with Tesla, right? They're, you know, in every fund, there's like 10% of it's in Tesla. They already have a good and, relationship with Elon Musk. So because SpaceX and because Starlink, so they're covering the globe and starting in 2021 with satellites that are supposed to deliver internet anywhere in the world. Okay, and you know, as a service, of course. Um, so that I think it's going to be like 40,000 satellites or something like that. 20,000, 40,000. Anyways, they're launching these satellites into space, and they already got satellites up there for Starlink. So Starlink and SpaceX are going to be working together, two different companies, but neither of them are going public for as far as we can see. But because ARK Invest is the ETF, and they're you know, a essentially an investment company, they can go and be like, hey, we want to buy X amount of Starlink, X amount of SpaceX, where it's not public to everyone. And because ARK Invest is, you know, public, we can buy into ARK Invest, and ARK Invest is going to buy into Starlink and SpaceX. That's the ticket in. And not only that, but they're also investing into, you know, um, Blue Origin, which is Amazon's space company, and um, Virgin Galactic, you know what I'm saying, which is public, but you know, they're hit and miss. So you can't miss that opportunity. If nothing else, if you buy nothing else, buy ARK Invest ETF for space exploration. Highly recommend it. Can't miss it. Excited. It's like Christmas. You know what I'm saying? Yeah. That and the other thing I'm looking for, all right, the last one, it's an ETF as well. Um, so there's this investor, Chamath Palihapitiya. He uh, he was on the project for what you call it, AOL Instant Messenger. He helped come up with that. He worked for Google. He worked for Facebook, and now he has his own investment company called um, Social Capital. And they have five ETF right now. They have five funds, and they just IPO last year, late last year. And so you know, he's the founder of Slack. He's the owner of the Golden State Warriors. Like this guy's he's on it. It's just and he actually has a social media platform as well. So it's just a matter of time before people start catching on and piling into his ETFs. But right now they're all under $20. IPO A through F is what you can find ticker symbol of social capital, and they're going again just like ARK Invest. They're investing into those disruptive fields, and those technologies are going to be around for the next 30, 40, 50 years, right? Because the way that you want to invest, man, you don't want to invest in yesterday. You want to invest in tomorrow, right? You invest in yesterday, that's old money. Those guys stop innovating. You invest in tomorrow because the money hasn't come yet, right? So yeah,
Capital.
that's IPOD, IPOE, and IPOF is the ones that you can get right now, and I bought all of them. So see where that goes. Yeah. Talking about the GameStop short squeeze this week is going to be just insane gains for this GameStop short squeeze. Um, and the most important thing is trying to find an exit strategy. I don't recommend doing this at all. Don't recommend if you're not on a train, you might as well just wait till the next one. But this is incredible. Finally, these Wall Street bet guys are taking on the financial institutions and just making insane gains with this, right? So I think the person who's leading it was deep. His tag name is like deep fucking value, right? And he's up like millions on this dude, right? So, uh, anyways, yeah, if you're in it, I know a couple people in the group are in it. Uh, Me myself, I'm buying in more this week, and yeah, just find out an exit strategy. Don't do this. Don't recommend it at all. But I'm getting in on, and I'm just going to try to find an exit strategy. Not doing this on Robinhood, especially don't do this on Robinhood. You know, do this on Webull, and you know, yeah, it's gonna be wild rides. But I think that since it was triggering last week, the stops were triggering at 69, and following the trend of whenever Elon Musk tweets out any types of numbers, either 69 or 420. I see this thing going up since it was triggering. They're triggering buy stops at 69. I think it's going to go up to 420, and then you can start probably seeing a sell off. I mean, that makes sense. It could go up to 1,000. I don't know, but for those guys out there holding it, diamond hands all the way, So, uh, but this is going to be an incredible event this week. I don't know how long it's going to last for, but don't recommend it at all. It's not investment recommendation, but I'm getting in on this. All right. Right. So, all right. We're looking at, man. I mean, just looking at the return, looking at return, what you could get, however much you invest. We're talking about 8x, 10x, whatever you get, whatever you invest in. So, again, I don't recommend it at all, but I'm getting in on this. So, yeah.
All right, millionaires and investors, thanks for listening. That's all I got for today. Stay tuned in for my next call. Doing this every week, and you can find those calls on the Zenvest Discord server. I'm gonna leave that link in the description. So that's all I got. Thanks for listening.